So the first thing you need to understand is actually the difference between the income and the revenue, and this is something very easy that you have studied in your basic accounting exam. Now, income is the inflow of the economic benefits. Income is simply the inflow of economic benefits. And when we talk about the revenue, revenue is the income from the ordinary course of business. Ordinary course of business. Now, ordinary activities or ordinary course of business means the principal business activity. The principal business activity. Like say, for example, if we are selling the cars, then revenue is the income from selling the cars. If we are selling the electronics products, then the revenue is the income from selling the electronic products. Now, there's a difference between the income and the revenue. Revenue is only the income from the ordinary course of business, but income can be anything. Income can be any inflow. For example, rental income, like if you have given your surplus property and the rent, and you are having the rental income, and we are assuming the rental is not the ordinary course of business. Similarly, for example, commissions, agency fee. If agency is not your ordinary course of business, like for example, you acted as an agent of someone and you collected an agency fee or the commissions on that, that is going to be the income or other income. Similarly, grants. So income is the inflow of economic benefits, and revenue is the income from the ordinary course of business. Revenue is also the income, but the revenue is the income from the ordinary course of business. Income arising in the course of entities' ordinary activity. That means the principal business activity. This is the basic thing you need to understand first. Now, we are going to deal with the IFRS 15. And this is the revenue from the contracts with customers. So this is a new standard. When I'm saying new, that means it has replaced two previous standards. There was IS 11, which was construction contracts. And IS 18, which was revenue recognition. So if you started with the CAT, Certified Accounting Technician, probably you know that these were the standard at that time. So IS 11, construction contracts, and IS 18, revenue recognition. Now these two standards have been replaced, merged, and form a new standard, which is IFRS 15. Now the name of the standard is revenue from contracts with customer. It covers both of the standards. Why they have again replaced the IS 18 revenue recognition? Because there were some ambiguities in it. There were some problems which was leading to the accounting of incorrect revenue. That is why they have replaced, and the new standard is quite detailed, and it actually gives more true and fair presentation by any means. Now, we are going to do this standard in quite detail. There are a lot of examples in your slides, class slides, you'll see that you will not find in your book. There are some examples from your textbook, but there are a lot of examples which you'll not see in your textbook because you know that I have actually copied them from the original standards. From different sources, I have compiled these notes. So there's a lot of research when I make you class slides, and I'll be telling you each and everything in this standard. But first of all, let's have a basic idea of the IFRS 15. Once you get the basic idea, then you will be able to understand the standard in a good way. So first of all, IFRS 15 states that the revenue should be recognized based on the 5-step model. The next 50 slides explains these 5 steps. But first of all, you need to have a very basic idea of these 5 steps. So first of all, we are dealing with the basic 5 steps. IFRS 15 states that the revenue should be recognized based on the 5-step model. Now, what is 5-step model? The first step is the identification of the contract. Like there should be a formal agreement. There should be a formal agreement between the parties. There should be a formal agreement. Now, when we say formal agreement, that means the rights of each parties are identified. It is probable that the revenue will flow to the entity. The transaction has the commercial substance. There has been a discussion on the price. So identify the contract, formal agreement, legally binding agreement. This is the first step. There should be a formal agreement between the two parties. The second step is identify the separate performance obligations within a contract. Like you will see these things nowadays, and these are very common things. Like for example, you go to buy a car, and they say if you buy a car, so we'll give you the service for the next 3 years and a warranty as well, which covers these parts of the car. If they are not working well, or for example, if you're having a problem, we are going to repair it or we are going to replace it. Now you went to buy a car and they said, okay, we are selling you a car, alongside we'll be giving you a 3-year service and we are giving you a warranty. That means now in this contract, in this single contract, they have 3 performance obligations. They have 3 performance obligations. The first thing they will be giving is the goods. The second thing is the service. The third thing is the warranty. So identify the separate performance obligations within a contract. So goods, service, and warranty, for example, the example I gave you. It can be the 2 things, it can be many more things as well. So the first step is identification of the contract. The second step is identify the separate performance obligations within a contract. And it can be either 1, 2, 3, 4, whatever. So you have to see your contract, how many performance obligations you have that you have to meet, that you have to provide to the customers. The third step is determining the transaction price. Now, when you talk about the transaction price, there may be many components in it. Like it can be either the cash, for example, you're dealing in the cash. It can be a fixed consideration. It can be a variable consideration. It can be a non-cash consideration. Like for example, fixed consideration means the amount has been mentioned in the contract. Now it is not going to change. Sorry, the amount is mentioned in the contract. Now variable consideration means, like for example, I'm going to buy the masks from a company, and they say, okay, if you're going to buy 1 million masks, this is going to be the price. If you're going to buy 2 million masks, this is going to be the price. Okay, the more I am buying, they're reducing the price, because we know that if we are buying in the bulk, we'll be having lesser price. Similarly, the non-cash consideration, it is quite common nowadays. Like it is not like every time possible that you are paying in the cash. Maybe you are issuing the shares. We did in the IFRS 2. So non-cash consideration, for example, you are issuing the shares. It is going to include the consideration payable to a customer as well. Now, this is something quite usual nowadays. Like, are we paying to the customer? Yes, there are a lot of circumstances in which the supplier, the vendor is paying to the customer. You probably have heard regarding the cashbacks nowadays. Like if you buy this product, the company will be returning you this 50 for it, 50 rupees for it. Or for example, $1 will be returned, $2 will be returned. It is quite common nowadays. Probably you have seen it. So what is we are actually doing? We are motivating them to buy our product. They will be paying, and then we will be returning a certain amount of money to them, cash back. So consideration payable to a customer. So there are many things which we are going to discuss in the transaction price. So again, the step number one is there should be a formal agreement between the parties. This is the step number one, a very important thing, step number one. The step number two is identify the separate performance obligation within a contract. When you're doing a contract, there may be more than one obligation you have. For example, you go to a company and you buy yourself a phone. For example, you buy yourself a phone. So, for example, you go to a company, you buy yourself a phone from a telecommunication company. They give you a phone, that is the goods. And alongside the phone, they give you a service contract, for example, for 2 years. Now, this is another obligation. Alongside that, they give you a broadband or the internet service. That is for 1 year, for example. Now, this is a separate obligation. So within a single contract, there may be many obligations. Similarly, I gave you the example of the car. You go, you buy yourself a car, that is the goods. They say when you buy a car, we'll be giving you 3 years service for it, every year, one service. This is again a separate obligation. Then they say we will be offering you a warranty for these parts of the car. This is again a separate obligation. So within a contract, there may be separate obligations. You need to identify that. Then allocating the transaction price to the different performance obligation. In the step number one, you actually determine whether there is a formal contract. In the step number two, you actually saw how many obligations the vendor has. In the step number three, you determine the total transaction price. But now in the step number four, you have to allocate the transaction price to the different performance obligation. Okay, what is the revenue you are going to allocate to the goods? What is the revenue you are going to allocate to the services? What is the revenue you are going to allocate to the warranty? Now, if you think that, are we paying for the warranty? Yes, probably you have seen in the market when you go, you buy yourself a phone or any product, they say, user, are you going to buy a warranty product or a non-warranty product? Warranty product is expensive than a non-warranty product. Actually, we are paying for the warranty, but we cannot buy the warranty separately. It is going to be attached with the product. If you buy a product, there will be a warranty. We cannot buy the warranty standalone in isolation, but yes, we can buy the product without warranty as well. Like for example, you go to the courier services to send a parcel to someone. So you say, okay, I'm going to send this mobile to my brother in another country or another city. And they ask you, okay, are you going to send the mobile? Do you want the insurance? Now, obviously they're asking you for it. It is not compulsory that you have the insurance. If you get the insurance, then your product get insured. Otherwise, you will bear the risk of any damages which they have clearly mentioned in their contract. So they're asking you for it. So if you say, yeah, I'm going for the insurance, so then you have to pay 1% for it. And over here, there's a rule, the 1% of the price, whatever price you quote, you have to pay 1% for it. So allocate the transaction price to different performance obligation in the contract. Recognize revenue when the performance obligation is satisfied. This is the last step. You are going to record the revenue when the obligation, the things which you were supposed to do, like for example, providing the goods, providing the services, when you are done with your performance obligation, then you will be recording the revenue. And the IFRS discusses two things over here: whether the performance obligation will be satisfied at point in time, or over the time. Like for example, you go to buy a phone, they immediately gives you the phone. That means when it comes to the goods, they have met their performance obligation at point in time immediately. But what about the 2-year service? Obviously, they are going to provide you the service over the time. So the revenue related to the goods should be recorded immediately, but they cannot record the revenue related to the services because it will be provided over the time. So this is the first thing you need to understand. Now we'll be looking at every step in detail. This is the first thing you need to understand, the 5-step process. Revenue should be recorded based on the 5-step model. All right, now we'll be dealing with the different steps in detail with examples. And you need to pay the attention because I told you this is a very important standard and easy one, but there are some technicalities. There will be some technical terminologies you need to be aware of, because in the exam, some questions may use exactly the same terminologies which you are doing in the examples. Step number 1, as I said, that you need to identify whether a formal contract exists between the parties. So this is the step number 1. Identify the contract with the customer. So the model applies where a contract and agreement between 2 or more parties that creates enforceable rights and obligation. Enforceable rights and obligation means a legally binding agreement exists and all of the following criteria are met. So you need to meet all the criteria. The first thing, the parties have approved the contract. And you know from your law paper, a contract can be in writing, it can be a verbal contract, it can be an oral contract. The entity can identify each party's rights. The rights of the party 1, the rights of the party 2. Both of the rights are defined in the contract. The entity can identify the payment terms. You know the 3 essential elements of the contract. Do you remember? The agreement, offer, and acceptance. The second was the consideration. If there is no consideration in the contract is not going to be a legally binding agreement. And the third element was intention to create the legal relations. The contract has commercial substance. Commercial substance, that means you're talking about the economic reality, which we also discussed in the previous standards as well. It is probable that the entity will collect the consideration, customer's ability and intention to pay that amount of consideration when it is due. So you need to be sure that this customer will actually be paying you. If from the very first day you think that you are not going to get the payment from this customer, if from the very first day you think you will not be getting the full payment from that customer, then obviously you need to record the revenue accordingly. Let's do an example and then you will get the concept. Example number 1. A vendor sells 1,000 units of a product to a customer in return for a contractually agreed amount of 1 million. 1,000 units for 1 million. This is the vendor's first sale to a customer in the geographic region, and the region is experiencing significant economic difficulties. The vendor believes that the economic conditions will improve in the future and that by establishing a trading relationship now with the customer, sales volume in future will be enhanced. Nowadays they are having the problems, but obviously this market is going to grow in the future and they will be having benefit from that. However, for this contract, the vendor does not expect that the customer will be able to pay the full amount of the contractually agreed price. So they know, because they are having the financial issues, they are having the financial concerns, so they will won't be able to pay the full amount. Consequently, the vendor determines that it expects to offer a 50% discount to its customer. That means they will be giving the 50% payment. Having considered the customer's intention and ability to pay, taking into account the poor economic conditions, it is concluded that it is probable that estimated amount of 500,000 will be collected. That means the 50%, half of the amount. So if the other four criteria are met, which was both parties have approved the contract, each party's rights is defined, the payment terms are defined, the commercial substance is there. If the other four criteria, the contract for the sale of 1,000 units in return for estimated consideration of 500,000 in accordance with IFRS 15. So you need to record 500,000. That means 500,000, not a full 1 million, because you expect that you will be receiving 500,000 for it. So from the very first day you were showed, you will be having 50% payment. So you cannot record 1 million. So you will be recording 500,000 from the very first day. This was the example number 1. Now there is another example. Aluna has a year end of 31st December 20x1. On 30th September 20x1, Aluna signed a contract with the customer to provide them with an asset on 31st December 20x1. That means after 3 months. Control over the asset passed to the customer on 31st December 20x1. Okay, so they have given them the risks and rewards. There is a commercial substance, there is a consideration, there is a contract. The customer will pay 1 million on 30th June 20x2. That means after 6 months. By 31st December 20x1, as a result of changes in the economic climate, Aluna did not believe it was probable. So when you say probable, that means more than 50% chances it would collect the consideration that it was entitled to. So they think they will not be getting the payment. Therefore, the contract cannot be accounted for. No revenue should be recognized because they think they will not be getting anything in response. So because they were sure at that time when they passed the control by 31st December 20x1, which is the year end, they know it is probable that they will not be getting anything out of it. So they are not going to record any revenue for it. Now we are dealing with the same step number 1. We are dealing with the same step number 1, which is identifying the contract. What if you have more than one contract, 2 or more contracts, more than one contract? How you are going to deal with those contracts? So 2 or more contracts that are entered into or at the same time. Like for example, if I am a vendor and I'm going to do 2 to 3 contracts with a customer, and with the same customer or the related parties, are accounted for as if they are single contract, provided at least one of the following criteria is met. If we are entering into 2 or more contracts at the same time or almost at the same time, then we need to treat those contracts as a single contract if any of the following criteria is met. What is that? The contracts are negotiated as a package with a single commercial objective. Like say for example, you say, okay, you are going to buy a smart PC, and then you say, okay, with the smart PC, I am going to buy the home studio as well, or the speakers as well. The contracts are negotiated as a package. Like you are actually buying one product, and they say, okay, I'll be buying this product and this product as well. The amount of consideration in one contract depends on the price of the performance of the other contract. Now it is quite simple. You see the same example. If I am buying only the PC, they will be giving me a different price. But because I am buying multiple products from them, they are going to give me the different price. Because I'm buying 2 to 3 things, 3 to 4 things. Due to bulk purchase, by purchasing many products, they will be giving me a discounted price, obviously. Now, what if I say, okay, I'm going to buy the smart PC, I'm going to buy the printer, I'm going to buy the speakers, and they say, okay, the price is this. But when they give me the discounted price, I say, no, now I'll be buying only the PC, the smart PC at the price you mentioned me later. They are saying, no, that was the price when you told us that you will be buying the speakers and the printer as well. The goods or services that are promised in the contracts represent a single performance obligation. That means when the vendor is fulfilling the responsibility, those work will be done simultaneously. So if any of the point is being met, then we will be treating many contracts as a single performance obligations because they are linked to one another. Sometimes you go and you buy the goods and you say, okay, I'm going to buy this, this, and this as well. But right now, you should deliver me this and deliver me these products later on. But the contract will be treated as one contract because there's a linkage of those goods. The price quoted is actually dependent on each other. And those goods will be provided, those performance obligation will be provided simultaneously. So if there are different contracts and they have the similarities, then those contracts will be treated as a single contract. These are not different performance obligation. This is going to be a single contract. Now you have the contract modifications. Now you have the contract modifications. Now the modification means simply the changes in the contract. Modification means the changes in the contract. Now, how there can be the changes? A contract modification is a change in the scope or price of a contract that is approved by the parties to that contract. This might be referred to as change order variation or an amendment consistent with the provision of IFRS 15. Adjustments are only made for a contract modification when either new enforceable right and obligation are created or existing ones are changed. Now, this is a very important point you need to understand. Like say, for example, if you are entering into a contract and then you later on you are changing the contract, you are doing some modification. And if that modification is imposing something new on the vendor, something new on the supplier, a new performance obligation is going to be arised, then that means that new enforceable right, then the modifications are going to be treated as a separate contract. They're going to be treated as a separate contract. A contract modification is accounted for a separate contract if the scope of the contract changes due to the addition of the promised goods or services that are distinct. Now, distinct means they are different from each other. If the products are different from each other, obviously it makes the sense that these are the different contracts. Like say, for example, you went to the computer shop and you buy yourself a mouse, for example, and then later on you say, okay, later on you enter into a contract to buy the speakers as well. Now, obviously, the mouse and the speakers have no integration. The mouse can work itself, the speakers can work in isolation. So that means these two things are distinct, different from each other. So their distinct nature shows that this is going to be a separate contract. The price of the contract increases by an amount of the consideration that reflects the vendor's standalone selling price of the additional promised goods, an appropriate adjustment to the price to reflect the circumstances of a particular contract. Now look, you go, even you can, see this thing. For example, you go and you buy yourself a burger and you say, okay, I want this burger. And then there are ads on, you see over there, ads on. And then you see, okay, I want another patty in it. Okay, if you want another patty in your burger, you have to pay this much amount further. So that means that contract is actually changing your existing price. Your contract is changing the existing price. Maybe they add something in it because obviously they have given, okay, this is the price of the burger and these are the ads on. So if you pick something from there, then obviously a little bit there will be changes in the price. But for example, if you are jumping into another deal and you say, okay, I need that deal as well, that is going to be a separate package. So sometimes, obviously, you have to see whether that contract is making any few changes in the price or that is completely going to be a new contract based on the standalone prices. Like for example, the mouse and the keyboard. You buy yourself a mouse and you say, I want the keyboard as well. Now the keyboard is completely a different thing. It has a different price. So they will be applying a different price for it. That is a separate contract. So if there are modifications, this is the thing you need to understand. If there are modification in the contract and that modification is imposing a new obligation on the vendor, is enforcing a new obligation on the supplier, then this is going to be treated as a separate contract. And the price will be separate as well. And the price is normally going to be the price which the supplier charges as a standalone price. What if you simply buy this thing, the price that way? When a contract modification is not accounted for as a separate contract, the vendor identifies the goods or services that have not yet been transferred. You know, like I remember once there was a sale, a discount, and I went. There's a brand Levi's or Denizen. So they said like if you are going to buy one shirt, then you have to pay full. If you are going to buy uh, three shirts, if you're going to buy three shirts, then the price will be 50%. I said okay. I bought three shirts at that time, and then I realized I should buy one more. When I went to the counter, I paid 50% of first three shirts, and they said, okay, for this one, the fourth one, you have to pay the full price. I said, what? You said if you are going to buy one shirt, then you are going to pay 100%. If you are going to buy three shirts, I assume it is three shirts or more, then you have to pay 50%. They said, no. You have bought three shirts. Now, this is a separate deal. Now, if you're buying another shirt, you have to pay full because this is going to be a separate deal. So they charged me 100% for the fourth shirt. And they said, okay, if you want to avail the discount on this shirt as well, you have to buy two more. So look, this is the policy of them. And they actually recognize the revenue accordingly. When a contract modification is not accounted for as a separate contract, the vendor identifies the goods or services that have not been transferred. Like for example, if they are changing the contract a bit, for example, we were supposed to provide them 5 units. They said, okay, no, just give us 6 units. We said, okay. So what you're going to do, you will be making the changes in the existing contract. Like you were supposed to provide them the 5 goods. Now you will be charging them for the 6 pieces. That's it. It is not going to be treated as a separate contract. But if you are dealing with the goods that are completely distinct with each other and they have no relationship, the price is separate, the standalone price is different, then that is going to be treated as a separate contract. Now you have the step number 2, which is identifying the different performance obligation. And hopefully you remember, I gave you the example. For example, you went to buy a car. So car is the goods. And they said, we'll be giving you 3-year service. So this is the services. And then there was a warranty. So I entered into a contract to buy a car. And then there are 3 obligations of the company to provide me a car, to provide a 3-year service, and the warranty. So these are the 3 different performance obligations. So at the inception of the contract, a supplier must determine whether the contract is for a sale of single deliverable or several deliverables. Is there a single obligation or multiple obligations? This is important as the revenue is recognized as these separate goods and services are delivered. So they gave me the car immediately, so they can recognize the revenue related to the car. But the 3-year service cannot be provided at once. Obviously, they are going to provide me the service over the 3 years. Similarly, warranty covers a period. When I'm buying a new car, obviously I cannot claim everything on the same day because everything is working fine. Maybe I do not need any warranty in the whole car life. So it is very important that at the inception of the contract, the different performance obligations should be identified.